Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Thursday morning. We have GDP today, so we're kicking off our conversation with what's going on with the GDP. Let's remember something, gang. As traders, we are not necessarily recession. This GDP is going to bring up the recession conversation again, gang. And in my 30 plus years, I've never traded in a way that was different than my process, prioritizing trends, support, resistance, volume, etc., because we have a recession. It just isn't a conversation that traders need to have. It's not even a conversation investors need to have. One of the historical tendencies for GDP and recession and all that technobabble around it is that it takes us a full 2 quarters, 6 months, to sort out whether we have this contracting economy or not. So two sequential negative GDPs. Why 2? Why not 3? Why not 90 days, right? So please remember, a lot of these measuring sticks are either due to limitations of the data, GDP only comes out every quarter, or some random number that we've all agreed on means something. We've assigned meaning to it. Why is a crash 20%, but a correction is, 10% or whatever these numbers are? So just keep that in mind. The other part of it is, by the time we have the third quarter, so another 90 days goes by, we get our third quarter, usually, take a look at 2020. Usually we're pulling out of this thing. Look back 10 years. Let's see if I can pull the columns here. Yeah, so, it's just not something I'm ever going to lose sleep over in terms of, oh my gosh, is my portfolio recession proof? These are all clickbait ideas. Please stand guard at the gate of your mind. Put the armor on, because most of financial media is designed to scare you. What I'm trying to say is every trader that I've met, and this is at scale and over time, the ones that do best and quite frankly are happiest are opportunistic. Yes, the market can be down. Yes, we can have ridiculously high inflation. Yes, the economy could be receding. But they never sit around saying, end the Fed. No, they don't sit around saying this, that, or the other thing. They just look at the landscape and say, where is the opportunity? And we just don't get enough of that out there in financial media. So I'm just going to remind you all, gang, where's the opportunity? And maybe just in building a watch list, which is something that we did in the Sector Secrets Mastery on Tuesday. So those of you that are with me know we do our portfolio session Tuesday every week at 3:00. We stay on top of this narrative. We stay optimistic. And then now I'll start to go from watch list to the actual price zones for the setup. This is going to be an opportunity. I'm showing you here, going back to 2013. Usually after those 2 sequential negative GDPs, we're already pulling out of that as we get to the third. Usually, right? So I'll just use that probability. In the meanwhile, let's see how bonds and Fed fund futures are reacting, right? We can always use measuring sticks for the response the market has to this GDP. Are bonds higher than they were the past 2 previous sessions? No. Did they go up? Yes. But what's the question we asked? Did we go anywhere new? We didn't. The next thing we can do is let's go back on over to my browser window, and let's jump on over to our CME FedWatch tool. Love this thing. Shout out to the CME for providing such a simple way to understand what's going on. All right, let's go to December. Anything different here? Gang, if you're wondering, why is the market up? Why would they be optimistic about this? I look at this and I crack up, because what a different look we have today. I've been talking about, look, I hate the idea of calling a bottom. I hate the idea of scaring people into some crazy low that's coming into the market, or getting too optimistic and sort of maybe a little too caffeinated, saying, oh, we're going up to the moon. Let's be more measured about it. Let's not clickbait ourselves. There's enough of that out there as it is. Look at 3.25 to 3.5. That's this column right here. And these are things that we go over on a regular basis. And I think if you're a viewer of Charts and Coffee, and I see a lot of my regulars out there, so shout out to my Caffeinate and Dominate crew and my Sector Secrets Mastery crew. What have we been talking about? 3.5 to 3.75 is where we have largely been expecting the target rate probability to be peaking and in likely December. Now what's happened? Not just 1/4 point less. And let me grab my drawing tools. Gang, this is so important. This is macro. You know what macro parades around as for most analysts and sadly most traders? Anecdotal observations about everyday life. Wrong. Hyperbole. Wrong. Headlines, even worse, right? We can go back to the main macro market pillar, and that's the FOMC. What are those chuckleheads doing? Take a look here. This is 1/4 point less a hike than we were expecting for most of the year. This is 2 or 1/2 point less cumulatively hikes. Look at what's happening. The target rate probabilities as we go into December are expecting less and less and less in terms of what the Federal Reserve can do before they top out. And it's really easy to see. This is February. This is March. This is May of next year. Right? This is June of next year. Here is July of next year. Right? Where funny enough, I know it's bonkers. I'm just looking at the data, gang. That actually represents 1 year from now, we're going to start to cut. Why do we hike rates? To slow inflation? Please. It's so that we can cut again. Really, it is just that simple. Don't get bogged down in the granular. Look, I'm not trying to get a PhD as an in economy, right? I'm not trying to understand economics at a PhD level. I want to understand it at a trader level. And a trader level maps to behavior. I hope that makes sense. I'm not trying to be an economist here. All right. So with that being said, gang, let's jump into your questions. I'm sure you all have a bunch. So let's do it. Let me jump on over here and boom. All right. There we go. And Alex asks, can we go over how I would determine my bias for trading this morning? Yeah, sure. Let's do it. So what would be my bias for trading this morning? It depends on what the market is. Let's just grab something sort of general like the S&P. We are below yesterday's close. No, actually, we're just barely above. So we don't really have a meaningful gap today. Certainly not a true gap. And I'm bored. I'm just marginally bullish, on the intraday time frames. It's a little difficult to see. Let me see. I can move this up just a little bit more. There we go. Do you see how my lower row of the multi-trend is yellow? Do you see how right here, it's yellow? And you can see my trade flag here. It's yellow where it says the word trend. We're inheriting a pretty neutral, slightly bullish environment. So that's something to keep in mind in terms of the process that I will use. Is there anything specific to the GDP? No, I'll take a look at the reaction. The GDP for my traders out there, you'll notice that it was pretty volatile, but it really hasn't. And notice how the green and the red zone, those are time and volatility based zones. They weren't smashed. They're a little wider. We would expect more volatility on a Thursday at 8:30. And they're still containing price to a pretty good degree. So while that was a fairly volatile event, we did not exceed in a dramatic way the typical historical volatility. So that's the beginning of my analysis for a day like today. Borderline bullish, neutral intraday, and I'll likely in about 20 minutes when I'm day trading with the Simpler Futures Room and my Sector Secrets Mastery, I'll be going in with that sentiment, a slightly bullish sentiment. And I'll prefer then to look for oversold stochastic zones as well as my HPMR green zone likely for entries, or even my V score at the bottom of its range. So I'll be looking possibly, most probably, for a buy. All right, next up is, and by the way, gang, the day trading has been very good. Why? Because we have volatility and we don't have session after session after session of continuous organization of sentiment and momentum and trend. We hardly have trends right now. So the daily swings have been tough. We actually scaled out nicely out of Nike yesterday before the FOMC, scaled out of Cisco for a small winner before the FOMC, and just took just kind of took a scratch, just no real gain, no real loss on XLF. Those decisions were made not from a profit standpoint, but from a protection standpoint. Let's take the money and run, as the trading song. I bet you didn't know that was a song about trading. Let's take the money and run, as the song says. Now I'm going to start building positions, possibly in gold, bonds, and we'll continue to move forward, possibly with even looking at where we could see overbought zones in healthcare and possibly, I don't love the idea of staples as much, but I do love the idea of a possibly overbought healthcare. So we're going to start to rebuild that watch list and be a little bit more discerning, but try to find some great daily time frames. But when that's not happening, the luxury of being a day trader allows us to do things, build our accounts, but not need session after session of consistent organization and follow through. So, that's managing time frames and managing time horizons with the strategy in mind really makes a lot of sense. I'm not a fan of multiple time frame confirmation, but I am a fan of picking one time frame for each type of strategy: day trading, swing trading, position trading. All right, next up, none of the ETFs are double green or double red. I think we have some double red ETFs. No? Karthik, I'll have to double check, but I think we have some decent trends at the ETF level. How am I playing the market these days? Exactly how we've been talking about here in Charts and Coffee. We've been day trading Monday through Friday in the Sector Secrets room. Really just a small 1 hour window, 9:20 to 10:30. We've been getting 2 to 3 setups in that window. Last time I checked, and bot, the bot always has the stats a whole lot better than I have. Our win rate's somewhere right now between 60 and 70%. Not too high, but clearly we're walking out of the morning more often than not by 10:30, 10:35 with some winning trades in our hands. So that takes the pressure off having to need. So bot says about 72. Oh, that high, 72%. Wow. Okay. So that takes the pressure off having to force trades on a daily. Are there trends? I was looking at some of these. I don't know that we have any daily trends. We have some weekly trends, but we have some trends within those sector ETFs at a stock level. But I haven't been forcing the daily, Karthik, at all. We've actually been, interestingly enough, excuse me, we've actually been focusing on weeklies for our position trades, because remember, we do that portfolio build position trading session every week. Those are weekly setups, and we don't need to micromanage these. And then in the meanwhile, gosh, the schedule tells you everything you need to know. This is what's working. This is my favorite time to set up day trades. And then we never forget, we love those daily time frames. We come back to those once a week as well. So ultimately, the plan is to be able to, like you said, find trends, but if they're not happening on the daily, look at the weekly, look at the 5 minute. So I think having that nimbleness of time frames and time horizons, that's how I'm doing it, Karthik. That's the best way that I can explain that. All right. Next up is IEF. I do like IEF, but let's start off with ZN. Off-road bear. I like that. If I'm looking at ZN, great Darvis level, overbought stochastic, neutral market with a proceeding downtrend. The market right now is reacting to GDP. And then remember, FOMC is the reaction. So Wednesday, 2:30, 3:30 Eastern. We got our FOMC reaction. Today's the reaction to the reaction. And, overall, I do like this setup. I just know that I'm looking at this in a window of hot zones, FOMC, GDP, scheduled, high impact, high volatility events. Gang, I put out there about 2 weeks ago, just so everybody knows, I don't give a rip about earnings. They're interesting catalysts for trades, but they're not going to necessarily sway traders and investors to change their mind about the economy, not when the FOMC has got the mic, right? So notice how the market's just really been completely blowing off earnings. I mean, we get that volatility. Cool, there might be some kind of trade in that little bubble, but overall, the reverberations are not, a factor at all, right? There's no aftershock really. So IEF, GDP, we know we're going to have a massive volatility event. I still like the short. I actually like the short side of IEF for a pullback. I don't have a buy here. I will not play a breakout buy. So it's short or nothing. And remember, that or nothing is a really important choice, gang. Flat is a position. Every now and then, I'll be a little frustrated about the lack of, say, daily time frame setups and swings, which is my bread and butter. I love day trading, and I think I'm pretty darn good at it, but I love daily time frames. That's how I cut my teeth as a trader 30 plus years ago, those daily time frames. But I'll start getting upset about, I'll just rant, right? We all have that person that we rant to. Well, my ranting soundboard is Trish, who many of you know. She designs all my classes, and she does all the content over at countdowntrader.com. I keep her really busy, and she's looking at what you all need in order to follow my crazy head. And one of the things that I'll hear from her a lot, and it's good to hear it. She goes, I thought flat was a position, Rog. I thought flat was a position. And yeah, I'm like, telling me my own stuff, but I need to hear it. So I'm telling you all, flat is a position, gang. The markets will be here tomorrow, and they'll be here the day after that, and the day after that, and the day after that. Don't force trades, okay? All right, what are my thoughts on Cisco? Hey there, Mark. Mark, I like Cisco, but my concern was, and we got out with a little bit of profit yesterday with more of a time-based eject button exit, because here we have the 10-year yield going down. Tech's going to like that. We've got the FOMC, pretty much guaranteed mosh pit volatility. And I thought, you know what? Timing-wise, it makes sense. Market trend-wise, it's not the same quality downtrend that we initially entered. Why not, again, Steve Miller Band School of Trade Management, why don't we just take the money and run? And so we did. And so now, what do I think about it? I don't know if looking at it now with fresh eyes, which is so much easier when you don't have a position, right? Now looking at it fresh eyes, Mark, I don't know that it would get my attention at this point. So I'll leave it be. I still believe it's overbought, and I still believe the path of least resistance is down based on what I see, but I don't know that it would make the top of the watch list, right? I don't know that it would make the roster. So for now, I think that based on what I see, the path of least resistance is likely down, but there might be better setups, right? Okay. Next up, RKT. Sure. RKT. It's under $10. So I'm under 10, under 20 is usually something I don't pay attention to. But here's what I'll tell you. When you get a stock under 10, especially, but under 20, in my experience, it's a volume game now you're playing. It's not even price only ever under these key price levels. It's volume. Find out where those volume ledges are. I don't know that I would be bearish, although the weekly is heading lower. So clearly you have that. I don't know that I would be overtly bearish here, but weekly is a double red downtrend. We're below the 200 propulsion on the daily. Overbought, possibly overbought right around 10. Keep an eye on where those volume ledges are. And I'll tell you, I typically do not trade sub 10, sub $20 stocks. So, I just want to be really upfront about, where I would put skin in the game or not. All right, next up, Matt asks, on the Darvis 2.0, okay, So that those are those yellow and purple lines all over my charts. The absolute best way for accurate, time-tested support and resistance. Again, you're just not going to find a better or time-tested way to identify turning points in the market by looking at previous, right? We're not projecting, we might turn around here. We're saying, hey, we've been here before. We knew what happened then. And I love support and resistance. That's a projection forward of previous behavior that gives an idea of what we could expect. So that's Darvis 2.0. Did I mention it's free? Absolutely, completely free. Head on over to countdowntrader.com. This is the Darvis 2.0 is not the same as Darvis. I call it 2.0 because I like giving credit where credit is due. Sadly, that's not something we see anymore. I was hugely influenced by the likes of Charles Dow and Nicholas Darvis. And I love what Nicholas Darvis did, but he was a 52-week breakout trader. Not my cup of tea. But the idea of the pattern and the boxes was brilliant. We modernized it, hence the Darvis 2.0, or as some of my students will joke and call it, the Rarvis. Darvis 2.0, and check it out. So on the Darvis, is the wave the same as the trend? So Darvis is automating support and resistance, my friend. Wave, or the trade flags, or the multi-trend, their job is to first identify the underlying environment that we're in, and second, especially when it comes to the wave, Matt, it's meant to be dynamic support in an uptrend, right? And dynamic resistance in a downtrend. That's its use. I think there are some write-ups on Wave and Darvis at countdowntrader.com, and you can check that out. So thank you, as always, for being here for Charts and Coffee. All right, gang, be good to each other. I'll talk with you soon.